How do we count rental income when you are qualifying to purchase a new home? Here's the deal. If you are purchasing an investment property, meaning that you plan to rent this property out, or you're purchasing a home where you're going to live in one unit and the property is a legal duplex, triplex, or fourplex, and you're going to rent out the other units, then we can count 75% of the rental income that you'll be receiving on the units that you're not going to be occupying. Now you might ask, how do we come up with that number? Where does the 75% of what? So when we order an appraisal on an investment property, that appraisal includes a rental schedule. And we will base the qualifying income off of 75% of that rental schedule. If the property you're purchasing already has a tenant in it, and that lease will continue with your new ownership, then we'll look at what's 75% of that number and base it off of the lower of the two, of the appraised value and what it's actually being rented for. If you have existing rental properties, then let's take a look at how we count that income as part of your qualifying income. We're going to base the income on that property off of the most recent tax return. But the calculation is not quite that simple because we look at the net income after expenses, but then we add back in essentially the cost of you having a mortgage on it. So we'll add back in the mortgage interest, we'll add back in the insurance, the property taxes, the HOA dues. Most likely we can add back in depreciation. And then when we look at the expenses to maintain the property, it's really going to depend on if those costs that you incurred that calendar year were one-time fees or if they're recurring costs. For example, if you put a new roof on your investment property, we can prove that that is a one-time cost and that's not going to be a recurring expense every year. But if you were just kind of maintaining it because it's a property that needs a lot of maintenance, then you can't add that back in to your income. So we will look at all of that and then calculate what we can use for qualifying income on that property. If you are purchasing a new owner-occupied property and you own a property now that you intend to convert into a rental, in some cases, we can even count rental income on that property to help offset the payments. Here's how that would work. You would get a lease agreement, you would find a tenant, and this needs to be a tenant that will be there for at least 12 months. Okay, we're not talking about short-term rental. You would find a tenant and write up that lease so that that lease starts, obviously, after you've had a chance to move into your new home. And we need to show that the first month's rent and any security deposit, or if you're asking for first and last, whatever those initial deposits are that are required on the lease, we need to verify that those funds have been deposited into your account. And that's what validates the lease as being a legally binding document. With that in place, we can count 75% of the rental income on that lease to offset your mortgage payment on your departing residence. In most cases, if you are purchasing a single family residence and there is maybe a mother-in-law apartment in the basement or a shed out back that gets rented out, we cannot count rental income from that because fundamentally it's not an investment property. It is your owner-occupied residence. There are a few exceptions to that. One of those exceptions is if you have a live-in aid. In that case, we can count the rental income, it's called boarder income, from that aid that they pay to live there. And we'll need to document that you require a live-in aid. So that's one example of an exception. And then there are a few programs, typically first-time homebuyer programs, where if you have a roommate who has been living with you, paying you rent, and then you pay the landlord rent, or you pay your current mortgage rent or mortgage payment, and that person is moving with you into the new property, and we can document that they've been paying you rent for the last 12 months, then in some cases, we can count that as qualifying income. Please do not count on that, as there are very few programs that allow for it. There is certainly an uptick in our community of ADUs and DADUs, right? The accessory dwelling units that folks are building in their backyards or attaching to their homes. And for conventional financing, we are not able to count rental income from those ADUs because it's a single family residence fundamentally, not a duplex. However, on FHA financing, they will allow us to count 75% of the rental income received in an ADU or from your ADU or DADU as qualifying income, as long as it is documented with a lease and we can show that it is indeed income that you are receiving or will be receiving.